If you look at the 5-minute chart here in the lower left-hand corner, I like that sell side right here. And the September, I'm assuming that's the 16th, really, because, or no, it might be the right one. I don't trust the dates on these, so I'm trying not to call attention to the dates. And also testing it to see if they agree with the ones I have. But anyway, because we opened up with a premium gap, opening range gap higher than previous day's settlement, it's most likely, a 70% chance that in the first 30 minutes before 10 o'clock or by 10 o'clock, it trades to mid gap. So we're looking for this price down here. And it's also pool liquidity resting on this little base of price action. So first presentation, fair value gap is here, right there. This is not where I want it. Hopefully, if all things are good this morning, I won't have a very long session, which is my intended goal. And let's take the midline off of that because I don't want to see it. There you go. And we're going to work primarily off of the 1 and 15-second chart today. Now we're trading into first presented fair value gap here. All right, so here we have this candlestick's high. You're going to look at the value up here, upper right-hand corner chart. So the high value on this candlestick is, where are we at? 19,793.5. We have yet to trade to number 3 candles high, which is 19,795 even. And this one I think is probably the same price as that. Yeah, same highs. So we have to trade to technically 794.75. We have not traded there yet. We have not traded there yet. That's using my model. That's how I would try to enter if I'm aggressively trying to get into a trade. I have a bias that would be bearish. All I'm doing is giving you a reminder that we're looking at mid gap down here. So settlement, previous settlement, opening price. Here's your opening range. Gap, and then we'll grade it real quick. Dropping the fib one. So then we have our upper quadrant we've already traded to. That's this right here and all the other time frames. And now we'll go back to electronic trading hours. My advice to Caleb is that if he's going to trade the day before FOMC, he needs to do it in the morning session, which is fine because that's his model. He won't be trading in the afternoons. I'd like to see this here jump up into that fair value gap there. The reason why I would encourage him to stay away from FOMC days is because he doesn't have the experience, and most of you probably don't have the experience if we're being honest, to not get excited about what you think you see in the charts, because that day is very manipulated, and even after the fact. Okay, like it's a 2-stage delivery. 2 p.m. tomorrow, the market's going to go one direction. It's going to shoot either higher or lower. You don't know which one they're going to do first. I don't know which one they're going to do first. It's heavily manipulated. And then at 2:30 during the conference call, Powell's a little bit like me. He likes to talk a lot. So sometimes that 2:30 counter run. So whatever usually happens at 2 o'clock, 2:30 usually runs right over top of that and goes the other direction. That's usually, not all the time, but that's usually what happens. Kind of like a non-farm payroll event. It's the same thing, but it's a little bit more exaggerated. And if you're wrong, or if you're over leveraged, you're probably going to regret that. And I just want to include that in his early development stage, just to avoid the day entirely. That way he can't be enticed to do anything. He can't feel any kind of regret. So what I was looking for is a run, because we had this low and then this low here, trading down into the upper quadrant of the opening range gap. That means the difference between 9:30's opening price, the very first tick opening print, today's trading, and yesterday's settlement price, when the market technically settles at 4:15. Since there's no trading at 4:15, it's 4:14 is the last print. So that's what you're looking for in the lower time frames. So between those two times, that's what makes up the opening range gap. Opening range is a 30-minute time interval, so up to 10 o'clock, and that's here. So we still have some time there. You want to keep your expectations kind of light also the day before FOMC. It kind of goes without question that, would anyone really want to go out there knowing that there's going to be such a volatile delivery and price? Like it's going to go all over the place tomorrow. So if you believe in the adage of buying and selling pressure, who in their right mind would be trying to position ahead large positions? Why would they want to get into the marketplace ahead of something like tomorrow's FOMC rate announcement? Like why would you want to do that? Why would they incur unnecessary risk? They wouldn't. All right, so there's the first presented fair value gap, and I was explaining it off of the basis of this low falling short of the upper quadrant level of the opening range gap, and then it trades down to that, sweeps that low, but it trades to the upper quadrant level, and then we created this little tiny little fair value gap. You see that in the lower lower right hand corner chart? When we were trading, I said I want to see it trade up in that fair value gap. In your notes, you want to write down for fair value gap trading, you can do high frequency trading, and it's not complicated. It's extremely easy. You can do it without a bias. And the only thing you're doing is looking for relative equal highs on a 5 or 1 minute chart. Once you map them out in close proximity to where we're at right now. So what would that look like? Well, you would have, we're going to use the 1 minute chart. Okay, I'm going to maximize this for a moment. So that's what I was saying about wanting to waiting for a little bit more time-based delivery. If you're expecting this just to go up there and fill like I would do if I was aggressive and it wasn't a day ahead of FOMC, getting in that entry price there, you would have to endure this. And when you know what you're doing and you understand the characteristics, you know what is going to happen. You know the likelihood that a fair value gap, a PD array, it might work through them. And that's not failure for the sake of the methodology. It just means that it's going to color outside the lines and get a little animated. And you can see that happening here. Sell side here. And there she is, right there. So that would be like a high frequency run to short term, either 5 or 1 minute buy side or sell side liquidity. Using no bias, just zero bias, just looking for a price run that takes out short-term highs, short-term lows, and you can do that all day long and not even have a bias for the daily session. I'm sorry, for the daily candle, or the session you're trading being like the New York session, the morning session, or the afternoon session, or if you're trading in the lunch hour. So now what I'm doing is I'm watching the this wick here, upper right hand corner chart. I'm looking at this wick right there. I'm looking at the 765 and a quarter level. Because we traded up into the first presented fair value gap there. I know some of you are probably short right now. This is the mid gap level down here. So mid gap's here and 10 o'clock here. So we'll see if we can get that mid gap delivery by 10 o'clock. There are mornings where you'll get in or you'll watch the price. There's the delivery to mid gap. So 70% strike rate. True today. And now we have the lower quadrant level here at 694 and a half. So that'll be our next downside objective. Okay, so we worked lower, got close to lower quadrant, left a small little gap here on the 15-second chart, and then now we're back in the high of that new week opening gap. So we have a couple more minutes before 10 o'clock. We have a short-term high here with a SIBI, sell-side imbalance, buy-side inefficiency. The first presented fair value gap here is obviously this candle here. That's candlestick number 2. So to get short, and I told you I wanted to see the move start, like I'm letting it go. I told you that this price here would have to trade to 794 point. You're watching this price up here, the high. To use my entry technique, it would have been shorting as it slammed into 19,794.75. You may elect to trade a sell limit order. That would be at that price, 795 or higher. You could try to get the consequent encouragement, but it might not go there. You can try to get the lower quadrant. That's probably a good price to reach for. Or if you're really, I guess, greedy, you can go in there and try to get to the upper portion of this gap. And you can see we just created a mohawk. So you can anticipate when the market will color outside the PD arrays. So your stop would be above this candlestick here. So anything you're shorting in here, you're stopped above this candle. So yeah, we wicked above the fair value gap, but that doesn't do anything to upset the trade. So if you know that it's going to be a day that has characteristics that allows and affords the market to be a little bit more muddier, where it colors outside the lines. How do we know that? How can we anticipate that? Because tomorrow's FOMC, and the morning or day before can tend to be a little bit more reckless and more wild. The price can be a little bit more disorganized, basically. And shorting in this first fair value gap, the gap itself formed at 9:33 a.m. Candle number 2 is where your stop is going to go, whether you're going long or short. So think like an algorithm, okay? An algorithm is just a recipe. So here's the recipe. This is your blue ribbon recipe from ICT, where all you have to do is follow this logic every single day. You're not going to get a winning trade every single day, but I promise you, if you study it, go back and back test it, you're going to see an enormous advantage in how you could have been making a whole lot more consistent moves, passing your funded accounts, getting funded, getting withdrawals, getting all that stuff, getting real money, turning your demo account that you're trading with these funded account companies into money-making machines. The recipe or algorithm is this. Every day at 9 o'clock Eastern Standard Time, you're sitting down and you're opening up the NASDAQ, or you're going to open up the ES. It's the same thing. You're not making anything different here. It's just the same process. So if I'm bearish, I want to see like, since I'm actively trading the NASDAQ, I would look at the E-mini S&P by comparison And we are in the December contract. We're not looking at the September contract anymore. Do you see the SMT divergence? Don't worry about price. I got another entry. Don't worry. I'm purposely letting things move around. These highs here. This high went higher than that one, didn't it? Now look at it here with the NASDAQ. See it? Now, by comparison, this looks a whole lot more animated, doesn't it? And when there's wicks, I'm looking at the bodies because that's where the bulk of the volume is. So there'll be times where you'll see that the wicks might be higher, but the bodies aren't. Inside this swing, compare that to here. So NASDAQ went higher, both in wicks comparatively between this highs and here. And in ES, I keep wanting to reach for the U for September delivery contract month. You see what's happened here? Y'all thought you knew SMT? You don't know SMT. Here's the high. And the wick went higher, but what do wicks do? What did I teach you? They do the damage. So this is an SMT divergence because the bodies in the high here are lower than this. Now, I like the 19,009 26 level. That's the equivalent of the September contract, and you can check that out. Look at your hourly chart on the NQU 2024 on TradingView, and then look at the August 27th through 29th highs. There are like 4 or 5 of them up there, real smooth. The equivalent for the December contract, which is what we're watching price in right now, that is the same thing here, right? So that's where those relative equal highs are. That's that big pocket of buy-side liquidity. If we don't go there today, I think that FOMC tomorrow will target that area. So that's just a very loose expectation. It's not a hard and fast, it's going to do it. I'm not betting the farm on it. I'm not trying to position myself ahead. I'm not in any trades right now. I didn't trade last night. I didn't do anything. I just hung out and made a little video presenting gray pools, which is a PD array that I'll talk more about in the book, but it's how you use wicks. Okay. And wicks are a PD array that you can look inside of them in that little gray area of what nobody would really pay that much attention to, a cluster of wicks. But the algorithm, because it knows every single high and low and it knows how to refer back to it based on its script, it's going to refer to those wicks in a manner that I outlined, and you can see it. So I'm not looking at supply and demand zones. I'm not looking at old highs and old lows for support and resistance. I'm looking at very specific prices, but where those prices reside in the matrix of where price is at the market. And if it's going to go lower, I'm going to be looking for discount arrays. I'm not just looking for inefficiencies like a fair value gap. I'm not looking for relative equal lows or a single low. I'm looking for clustering of wicks because nobody's paying attention to them. No one's making any effort to see what was the purpose of that flurry of price action, redelivering multiple times in that area where you have multiple wicks overlapping. Right. You think the algorithm, if you can just give me the stage for a second, assume for a moment, if you don't believe there is an algorithm that controls price and it delivers price and it's a price engine, if you don't believe that, pretend for a moment that you did. Wouldn't it be logical if there were a algorithm that even that little messy area of a clustering of wicks, all different lengths and such, wouldn't it still have to work with that information there, or otherwise ignore it? And what problems would it create if it was ignoring that? And why would it ignore that? What would set the precedence over something else in the marketplace that the algorithm will refer to versus something like that. But then when you start seeing it like I'm teaching in the future with this, you'll see that you have an x-ray view of price. You'll be able to see things that are not technically in your chart. That I believe this is where we're going to aim. Now, because that is a likelihood, and we have big news coming out tomorrow, I would not want to position very large today. I would not want to swing trade today. I think it's more reasonable to see them leave this here. It's just a real easy candy store to rob and just go in there tomorrow and smash it. They can be chopping around and do all kinds of, subtle ranging, creating consolidations that many of you would be frustrated by. But when you understand that these are the conditions and characteristics, you won't be in here trying to trade larger or more frequent than you should. So what happens if you know that this is the likely draw? If you filter out all the high frequency trading that you do sub 1 minute, aiming for short-term 1 minute or 5 minute buy side, using a 15-second fair value gap entry model, you're filtering out all the potential for you to get nailed if they do in fact want to run up there and hit that. So you see, it's not just give me the right fair value gap, give me a PD array, give me a straightforward model. I just gave it to you this morning. You're looking for a gap of 40 handles or more. Okay, the larger above 40 handles, the better. What was the opening range this morning? Previous settlement price at 661, 795. Hello, that's over 100 handles. So you are in a jackpot. Like you have an easy 70% chance. That's not a 100% chance, folks. That's not a guarantee. It's a 70% chance that in the first 30 minutes, you have an ability to sit down, know exactly what you're expecting to see in price. What is that? You're expecting the price from this opening price here at 930 to gravitate down to half of the gap. You don't need the whole gap to close. There are things that you can trade with that gives that idea. I'll teach a little bit about that. But why worry about having that when you got something that's statistically probable over 70% of the time, gap opening higher, more than 40 handles. The larger the gap, the better. That means your range is more opportunity. So from the opening price, as soon as at 930 opens up, you know what that price is. Everybody else knows what that price is. Down to that gap's midpoint, which is 728.25. So you have essentially, what is that? 50-ish handles. Large opening gap higher, wonderful. Find the mid gap. There it is. Find your opening price. That's your range. That's the profit potential, okay? So now what do? You wait. In 1 minute from the opening price, you can take your time. You got 60 seconds to say, okay, what's the math on this? Here's my opening price, and then the mid gap price is down here. Once you anchor your fib to the opening price, that's your price you're aiming for. That's your range between this price and that one. So you know your bias is what? You're going to try to go short. So now what do you wait for? You just go in and go short? No. You watch price. You wait for it to do what? Create the first presented fair value gap. This is the first fair value gap. This candle here at 933. So it meets the criteria. It can't be on the 930 candle. 931 is the easiest and first, not easiest, it's the first earliest candlestick that can create the fair value gap, candlestick number 2, that one that makes the imbalance. This is candlestick number 1. This is candlestick number 2. Here's candlestick number 3. So candlestick number 3, your entry is either one tick below if you're aggressive like me and you know what side of the market you're trying to get in, and you just don't want to miss the move, because I trust this model. I could trust this. I could be selling short there, and any opportunity it's inside that gap here, I'm going to short. I will short right at that mohawk because the stop's up here above this candle's high. The number 2 candle, That's the in imbalance where it's this number 1 candle's low and number 3's candle's high. Anywhere in here, go short, stop up here. So this little spike here, they can crack jokes all they want, but I just gave you something they can never deliver. And this is such a good model. It answers everything. When it starts to break down, you find a short-term low. Once it breaks that, you put your stop loss to cover costs. If you have more than one contract, you take a partial below the short-term low. Everything I'm saying here, when we have a gap lower opening, more than 40 handles, 50% of the gap is your target. Wait for the first presented fair value gap, and you're going to be using it as a means to go long and trade up to the half of the gap. Here, first fair value gap here is your entry mechanism to get down to mid gap. And you have a 70% strike rate built in. You've got a home field advantage that this is going to happen 70% of the time. Daily. Now, you can further increase that strike rate by understanding the economic calendar. Hello. And understanding the likelihood of what happens if you take 75 to 80% off of the trade at the mid gap and you don't have the experience and you want to see if you can go down to close the entire gap. Okay, just put your stop loss somewhere above the short-term low you took profit at, or partial. And if it stops you out on the bounce, who cares? At least you had a free look. You did 80% off here, remaining from the position after you've taken off a partial. Or don't do any partials. Just expect that it goes below this low and accelerates to mid gap. Look at the bodies. Look how the bodies are respecting that mid gap level. That's algorithmic. Caveat now. Here's the spin on that logic. As long as price remains below your stop loss when you're short using this model, and we have not traded to the mid gap, you stay with the trade until you're either stopped out or you get your target. Is that complicated? Nope. Now, how could you mess this up? Okay, here's how you're gonna mess it up. You're going to over leverage. You're going to try to trade before the fair value gap is traded to. You will not take the trade because you haven't watched it enough times for weeks and months to desensitize yourself to it. If these parameters are there, 40 handles or higher, there has to be 40 handles from previous settlement price to where we open first or more. It's better if it's larger. It's really, really good if it's larger than that. If it's over 200 handles, I've seen in the last 2 years or so, I will defer trading this setup because chances are it might still keep running because something out there's heavy manipulation going on. So 100 handles, let's make it a little bit clearer. 100 handles approximately, minimum 40 handles. That's your sweet spot, okay? You can see, look at the characteristic of this market right now. I got a little carried away. It's just ranging. And that's classic the day before FOMC. So I'm going to strip this down to the 2-panel view. All right, and then I want that 15-second on the right side. And this is your 1-minute chart. I'll take this off here. All right, so see what they did here? We have these lows. This is jagged on the bottom end. What's up here? Short-term buy side. All right, so hopefully you can get a little bit more displacement here on that candle and give us a fair value gap. See, that's what I don't want. I don't want to see that. Now we have my buttons open. Crap. It's too close to the liquidity. So let me go back to this real quick. We had these lows here, and this was made jagged. So sell stops down here on the 1-minute chart were taken. Right now we're looking at how prices respecting that September 1st new week opening gap. There's an overlap of here. This low is a new week opening gap low. I'm watching the bodies here on the 1 minute chart. So we don't have any buy side to refer to here on the 1 minute chart. There's those relative equal highs on the 60 minute chart for December delivery, the contract. All right, so we have this high right here. You see that? Let me widen this out a little bit. For December contract, we have this high. It's moving still closer to the 19,926 level. So now that level, I'll change its style a little bit so that you can see it differently. All right, so there's another pool of liquidity buy side, and it's framed on the hourly chart. And all we're doing is providing a means of framing and exercise. Now, I would like to see this stay open because we already dropped into it here. And it didn't stay open there. But I would have seen it stay open if it started to displace higher. Then that could have created a fair value gap. That's what I mean by that. So new week opening gap on September 1st, just about near its high there. All I just did was annotate the minor buy side and sell side. How do I know that there's buy side? Because the market turned here and went lower. We created a swing low here, and this candlestick right there, as soon as it closed, that validated this as a swing low. So anyone that's long, they could theoretically, and that's all we're doing theoretically, is assuming that there's going to be some measure of stops below there. And then the buy side would be here. That candlestick right there, when it hit that, that was the entry for buy side. And then I would want to see inversion in here. We have this big block of back and forth price action where it spent time, a lot of time back and forth in this range. So 19,813.50 is also September's 13th daily high. So I'm not impressed with the run below the short-term low just to get to that level. It's not like I don't see it like it's breaking down to keep going lower. It's going to have to prove something significant to me. On the downside, I'm more inclined to fish on the upside, and it can drop, and it's fine. It won't be something that I would be regretful over because you have to have rules, and the rules here. I'm not trying to be short. We've already shown a willingness to gravitate towards that 19,862.75 level, and that's not even close to the relative equal highs at the 926 level. Breaker, low, high, lower, low, this candle's range, and we have that little inefficiency there. That's where we're in. We're inside of that right now, so I'm watching it. So we're inside of September 13th old daily high, and while I'm talking on your own charts, you should drop a line on that September 13th daily high, and you'll see what that level is. But here's a breaker. So that would look like this. So I'm not inside that range right there. Ugh, it's too dark. Now, if we lose this range to the downside, then we may have done enough for the morning session going into the lunch macro, where they'll move against the traders that have been long. That would be this sell side resting right here on the left-hand side chart. But it has to leave this blue shaded area. If the breaker wasn't there, this would be the short. Now buy side goes to here. And new week opening gap. If it's going to go below here, it's reasonable to see it try to reach into that as well. 1050, 1110 macro. Sell side. That little gap right there, that's the one. But I wanted to see it come down and give me one tiny little gap below that. That was the one I was wanting to aim on, but I gave you this before it happened, so it's a consolation prize, it's called that. All right, so day low here. I'm not convinced that they're going to come down that far, but I'm willing to give it another opportunity to sweep below here once more. So this low now becomes sell side. So any little rally in here, as long as I don't go to the mean threshold of the breaker, that's this range here on the 1 minute chart. Then it could be just setting up a retracement here, just dive one more time and get into new week opening gap low. Then if I can get a rally after that, I'll work with any fair value gap there to trade back up to the breaker, if it can afford me 20 handles range. That's the filter. It's got to give me at least 20 handles of where I try to get in at and where I'm trying to aim for. If I can't frame that, then I have to sit still. And we can see the moves coming, but it's not frameable based on the logic I'm performing for Caleb, which is 20 handles run from entry. Now, because we're below this breaker, low, low, high, lower low, then rallied to new week opening gaps, broke down, went below the breaker here. So as long as we're below half of this range, I wouldn't be interested in anything long. So what I'm saying is I'm looking for some reason for the market to fail to get above the midpoint. It can trade where it's at here. That's normal. It can trade right up to it. But the gaps, the PD arrays, everything that I have that I key off of in price, they all have an inverted aspect to them. So they can be treated the opposite. So what you think about classic support resistance, I can apply that to these things here, but it's not classic support resistance. It's very specific candles. It's very specific prices. The low, the lower quadrant, and the halfway or mean threshold, because it's an order block. So half of this breaker to its low, that's like the area where the turn could happen, and a run below this low down the end walk. That would be a setup. We have a gap here. If it runs away again, then it's just making my day longer. I want to put a short on so that way you can see trading against a higher time frame likely bias on a day prior to FOMC, late in the morning session. I see it wanting to take this short-term high here first. See how much time it's staying inside that gap? All here. You don't want to see that. And that would have been stop out. So I can see where I'd be wrong. And as much as it would probably be entertaining for some of you if I would have took that entry, I just know that it's not there yet. But using that one, you would have been stopped out, or I would have been stopped out there. How did I know that? Well, it's because I think that this was too easy, too shallow. And I think that either they're going to send it higher or they're going to take it right above this high anyway before it goes below these relative equal lows. So we're in between that little, I can justify both sides. And if I can do that, it's not high probability. So it's giving me the ability to show you, Caleb, that just because it looks like it's a fair value gap, where we're at, what time we're at, and how it just delivered that little tiny wick into the lower half of that breaker I was annotating. I feel like we've pushed it up a little bit from 930's high. We went lower. We consolidated, made all of this in here jagged, and once more here after trading into the new week opening gaps above the initial high of the day. Because we've had 1, 2, 3, 4 lows produced to the downside, this is really, really jagged. And I would be trying to sell short in the very like low end of the range. So what would I be doing? Selling here. I'm selling a discount. There's people out there who want to buy something cheap. So I'm watching this high here because that'll tell me what I want to do. I told you I'm not leaving until I get something that I can frame on. So now we have somewhat of a balanced price range in here. I mean, it's on the 15-second chart. I don't want to make too much of that, but this little gap here, we're seeing these little tiny candlesticks reaching up. I would like to see it just go above this high here and then come back down into this inefficiency and see if it can support it with inversion characteristics. Take this midline off. I don't want to see it hit the bottom of the breaker block and come down in here. I want to see it take this high, come down, hit that, and then if it shows displacement higher off of that, then to me it's a little bit more trustworthy to the upside. And then I can entertain maybe a run into the high of the breaker or this inefficiency right there. Now take a screenshot of what we're looking at here. This is exactly where you can identify where you do not want to trade. I'm going to force myself to trade in this environment because I want you to see the difficulties of it. I'm probably going to fail in it. That's why I'm telling you don't copy this one. But I want you to see before I do anything, look at how it's behaving. Is it animated to try to get anywhere in a quick, fast, sudden manner? No. It's just like, I'm just moving around a little bit lethargically. Either side of the marketplace, it should have dropped here if this was a valid fair value gap, which I told you because of all the things that are on the 1-minute chart, it doesn't bode well for selling short that cheap or low in the daily range after it's already had this big drop down. So this lunch macro where it took the sell side out over here, that right there might be the low, and we could be higher in the afternoon. That's what I wanted right there. Now, because this inefficiency is the only one that has of any interest to me at all, I want to see, do they dive it back down into this? And then if it can hit this, but not go through it with a body, if it can hit it and displace higher, like a big, nice series of 1 or 2 candles to the upside, create an inefficiency there, then that could be a catalyst to get us up into that inefficiency there. But I asked you to take a screenshot because the way prices just meandering around, okay, that is what happens when the market enters a buy model. It just buy program, where it just starts ticking higher. It doesn't matter how many people are selling short or buying. It's just going to keep offering higher prices, keep higher, and it starts squeezing and squeezing and squeezing. And then as it gets to a level where there is an inefficiency or liquidity, and on the 1-minute chart, you see it right here. That's that short-term high. These are very, very challenging conditions when it's behaving this way. All right, so now we're back above the mean threshold of that breaker over here. That's this candlestick right there. It's the last up close candle right before the drop down to a lower low there. So it's a low, high, lower low. It did not come down to hit this area here. It just kept booking price higher, 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 higher. So they're going to make a mad dash up to attack these buy stops. So we're back at September 13th's daily high. Top of the breaker. Now, because we have this area of inefficiency, now mind you, it's anchored on a 30-second chart, so bear that in mind. It's not like it's on an hourly chart where if this were an inefficiency in this time frame were a 1 hour chart or 60-minute chart, price would have no problem going up with one single candle into this little area. It can still do it on the 15-second chart. That's still a characteristic, but because it's only in a 15-second chart that it has this inefficiency there. Because if you look at it over here, it's been offered buy side delivery and then this single candle on the 1 minute chart. Inside that 1 minute chart's range, we have this small little inefficiency there. So keeping to the rules, I'd still would like to see it ram up in there pretty quick. And if it's going to get in there, why not just take out the liquidity right there? All right, so we're at mean threshold, half of the breaker. And we have the inefficiency right there. And I'd like to see that be used as inversion. So it would, you want to see it go away from a little bit and come back down into it. And then run up into that inefficiency right there. Now look at the delivery of price here on the 1 minute chart. Watch how when it goes higher. Do you see any gaps? This was immediate rebalance. Rally, 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 rally. Small little volume imbalance there. But no fair value gap. See that? And then delivered to the high of the breaker. This is classic. This is why I tell you, take a screenshot of that. Because when you start seeing price doing this, that is the algorithm in a buy program. That means it's simply going to keep offering higher prices. It does not matter what your little book map things say. It doesn't matter what your liquidity things say. It means it's just going to start marching higher, 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 higher. That was the reason why I stopped. I was going to take the short in here just to illustrate. This is shorting. And I was like, you know what? Why do that? It's better for me to illustrate why that's not even a good one. So the screenshot of you seeing how price is not giving you any kind of fair value gap. It's just one steady, just booking higher, booking higher, booking higher, booking higher, and no inefficiency. So if you're offside in that, it's very, very painful, extremely painful. Notice the bodies, we never left it and came back down. The bodies are staying inside of it. So is that displacement to the offside? No. I believe it's going below this low, so that way we understand what I'm expecting. We had this nice deep retracement. It pressed higher, 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 higher to the top of the breaker. We couldn't find inversion there. All the bodies stayed inside of it. Nice displacement to the downside. We rallied back up. I want to see this small little segment of price action here stay open, meaning that I don't want to see it trade back to the bottom of that blue box or into that volume imbalance. I'd like to see that stuff stay there. And if we can find ourselves heavy in this area, that should allow for a run to get to the sell side. We still have to wait for the fair value gap that makes sense, and that isn't making sense yet. It's got to still work out the creases. So knowing how you can fail, knowing how you can lose money, identifying it, and saying, no, this isn't it. That's going to come with experience. It's not a matter of going out there and try to trade everything and make money. The main thing is capital preservation. See, I don't like that. Ideally, it should have went to consequent encroachment of that gap right there. Why that one? Because it's matching basically this one. Single candle up, single candle down. They're sharing the same spatial range between their highs and lows that make this imbalances. So that's a balanced price range. So I want to see it trade down below it and show a willingness to hit half of that and then drop. Then that drop would be candlestick number 2 of a fair value gap that I could use to get in to get short and then run down here. But since it's not doing that, I have to sit still. Now we got the volume imbalance redelivered to. And now we're at, I mean, it could roll over here lower, but it needs to show a displacement sharply down to the downside. I want something at mid range of this gap down here. Even though this is a higher price, that if it's going to drop, this would be a better entry because it's a higher premium price. I don't trust that my entry there would be sound. Now I don't want to see, if I want to try to frame a setup, which is what I'm trying to force myself into taking a short to this low. Yeah, I don't want to see it support price there. I like to see it lay down a candlestick, but not close outside the low of it and create a inefficiency so I can position inside of that. Volume imbalance, deliver to that. Now this right here, just deliver it, man. There you go. Now don't run away. Don't run away. Don't run away. Don't run away yet. I want to see if we can touch the bottom of that inversion fair value gap. Not yet. Come on. Volume imbalance right there and the low. Oh, you fucking kidding me? Okay, well, we're gonna have to pretend. Okay, the stop loss would have to be above this candlestick's consequent encroachment of the wick. That's where my stop would be. So that way you can see where it would be at. Told you I teach with a demo. So some of you okay, so it would be one tick above that, and the limit order would be at that price. Okay, 745 and a quarter. It's this fair value gap there. Trading view. Come on now. This is the gap. Right there. That's how I was eyeballing. There you go. You can take a partial there. So you would be in with the stop that covers the costs, and you'd be in one partial already. That would be a partial. So now you'd have two partials booked. Stop would stay right where it's at. So it doesn't matter where it goes now. You stick with it and aim for this lower here. Stop would roll to here, and you'd stop out on the balance there.